Hi everyone, welcome back to the channel. In today's video, we are going to dive into one of the most important topics in accounting, which is inventory or stock valuation. We'll be looking at why inventory valuation matters, the different methods businesses use, and how it affects things like profit, cost of sales, and even taxable income. Right? So whether you're a student or just brushing up your knowledge, obviously, this lesson will help you understand the first in, first out, weighted average, and specific identification method in a simple and practical way. So let's get started. Now, we have the inventory or stock valuation, right? So this is basically a guide to basically understand how businesses value their stock and how it affects financial performance. Now, let's look at the definition of inventory. Right. So now, inventory basically refers to goods that are in various stages of production or ready for sale. The different categories of goods are as follows, right? Remember that with inventory, it is just not one thing. It's basically a lot of things. But now we'll look at the categories that we actually put it under. So the first one we have is raw materials, right? We have raw materials right there. So now with raw materials, we basically have unprocessed material or goods used to produce goods, or intermediate or semi-finished goods and finished goods, basically, right? So with raw materials, what you're talking about, let me just say you have a bakery. With the bakery, your things like your flour, your milk, your eggs, those are your raw materials because those are unprocessed materials, right? I know somebody can say, but sir, milk is already processed and stuff, but remember that milk is not the product that we trying to get to. This is a bakery. So if it's a bakery, your milk, your flour, and your eggs are basically your unprocessed material, right? Because you are going to use those goods to produce goods, right? Then after that, now the second one we have is work in progress. So work in progress are basically goods that are in the process of production. They are partially finished goods that are awaiting completion. So remember, for example, like I said, we have opened a bakery. What's gonna happen is that now, your when you have made maybe your bread in the bakery or your cake, you see, I don't know what to call it, but the dough that you literally put in a pan in an oven pan, then put in the oven for it to actually become bread or to become a cake. That's what you call work in progress because now it's still in the process of literally being a finished good, right? So that's basically what a work in progress is. Then last but not least, we literally have the finished goods, right? The finished goods are basically manufactured products in stock that are available for consumption or sales. These goods do not require any further processing. So basically, when you have our cake or our bread, at the end of it all, those are basically the products that we're going to consume or we're going to sell, right? So that's basically what we mean by finished goods, right? So I hope that makes sense right there. Now, let's look into inventory. Remember here we looked at the definition of inventory, but now we're going to look at inventory. Inventory is basically it's generally the largest current asset and it is expected to sell within a period of 1 year. Right. So this one it explains itself that with inventory, remember inventory is an asset, right? Remember we own it, so it's an asset, it's your trading stock, and it is expected to sell within a period of 1 year. But it depends. It depends on the business that you are running. Stuff like there are things like cars. Remember that with car dealers, even though it is expected to sell within a period of 1 year, there are some dealers whereby the cars can literally be at a car dealership for more than a year, right? So there are things that you would basically still find in the store or after years, right? It literally depends on what you are basically selling, right? So that's just the first line of it, right? Two is that businesses should do inventory count to determine the value of inventory missing, stolen, or damaged. Remember, if a business doesn't do an inventory count, they won't know the value of inventory that's missing, stolen, or damaged because in their heads, they will literally think that the stock that they had and the ones that are selling um are the ones that are actually, out there. So meaning that if they bought 1,000 units of something and they already sold 500 units of something, they would think that they're left with the 500, right? But sometimes things like your inventory can go missing, can be stolen, or can be damaged. So if they don't do marking an inventory count, they won't know if there is any inventory that is missing, stolen, or damaged because they never check, right? So that's just what it means right there. And then now they also say that the inventory count will also assist in determining the items of stock that are selling slowly or items that have been overstocked. So remember, sometimes when you have a business, there are products that are not going to sell that fast, and there are products that you're going to have more of it, right? Remember, um, imagine if you were to sell maybe Pick and Pay. Let's just take Pick and Pay for an example, right? For this inventory count, right? So what happens is that when they do an inventory count, they find out that, you know what, when you look at our cold drinks, right? At our cold drinks, uh our stony cold drinks don't actually sell that fast. They are selling slowly. So meaning that not a lot of people are buying stone. So basically inventory count helps to tell them if there are products that are being sold slowly, basically, right? Then overstocked. Sometimes you might find that maybe the snacks that they stocked up are many, and not a lot of people actually finish those snacks, basically, right? So that's when now they start doing your things like your sales, so that they can try to, try to sell them out before they actually expire, right? Then now, the overstocking of items, it places businesses at a risk of being stuck with merchandise that is obsolete. So by that we mean that if you have more stock that is not selling in a business, the products, obviously, they basically are gonna be expired, or they're gonna be outdated. And if you're selling food, most definitely the food is going to spoil. So obviously that is a risk that comes if now you're overstocking products in a business, right? Then now obviously they say that obsolete inventory should be marked down in order to sell. I meant to say sell, this my bad. And profit margins or markup are reduced. So basically is what I was saying, that is when you have overstocked something and now you can see that it's no longer selling because you stocked up a lot of it. That's when you start doing sales. Now you try to sell it at 15% off or 50% off, right? Just to make sure that you clear it out. I hope those points made sense there. Now, we're going to look at the two inventory systems, right? We have two inventory systems in accounting. We have perpetual inventory system, and we have a periodic inventory system, right? Now, let's look at the perpetual inventory system. So the perpetual inventory system is basically the movement of stock is recorded on an ongoing or continuous basis. So meaning that this one, each and every day or each and every minute or each and every hour, they literally recording the stock that is moving, the stock that is coming in, the stock that is damaged, the stock that is returned. They keep on recording it continuously or ongoing, right? They make sure that each and every time they sell, or like each and every hour, each and every day, they make sure that they basically do what they make sure that they get the movement of the stock, right? They record it basically. Then after that, the exact quantities and types of stock items on hand are shown by the system at any point in time. So obviously with this one, if we know how many stock came in, how many stock we sold, how many stock they returned back to the business, we definitely do know how much stock we have in the business, right? Because that way we record each and everything that happens, so we know the movement of the stock. So at any point, if they were to ask us, hey, how much stock is left? They just check on the system and they're like, oh, we are left with 2,000 units of this and that and that and that, right? Then now we go to periodic inventory system. Now with this one, there is no continuous recording of the movement of trading stock. So this one doesn't matter. You'd be selling 500 chocolates in a day, then they wouldn't even know that you sold 500 because they never recorded, right? There's no continuous recording of the movement of trading stock, basically, right? And the value of the trading stock on hand is worked out or counted periodically, right? So let me explain that part. So now remember that with the first one, which is perpetual, they used to do it maybe on a daily basis, hourly basis, or on a transaction basis, right? Um, but now with the periodic, now they have set up a time. Maybe they would say that each and every month, that's when you're gonna actually check the trading stock on hand that they have. So that's what they mean periodically. So meaning maybe after a week they check, after a month, maybe after a year on a yearly basis, right? It's not that one whereby when they make a sale they record, when they return stock they record and all that. No, no, they do everything after a certain time, right? And this system is actually mostly preferred by small businesses, right? So yeah, small businesses they basically check their stock after some time. Now, let's look at the calculation for say for cost of sale, right? The calculation for cost of sale for the two inventory systems, right? So for the perpetual inventory system, the cost of sales are literally calculated at the point of sale. So meaning that when you sell something or buy, when you buy something or return something, at a business, and that is using perpetual inventory system. They record it right there and then, right? They don't do that thing of saying that I'm gonna return it later. I'm gonna record it later on. They don't do that. Then with a periodic inventory system is that the cost of sale is calculated at the end of the financial period, right? So it is calculated at the end of the financial period, right? Like I said, that they might do it on a monthly basis, they might do it on a yearly basis, they might do it on a weekly basis too, right? That's also something that they can do. So now on this table here, we have how they would literally check um the stock actually the stock that they have in the business by using by using the periodic inventory system. This is how they do it. They will first have the opening stock. They'll first have the opening stock. Then they're gonna add the purchases. So the stock that they bought, that they stocked up, right? Remember the trading stock that they brought from suppliers. They're going to add it to the stock that they already have. Then if there are any carriages, they're also gonna add it on the purchases. Also, then if there are import duties, they also add it to the value obviously of the opening stock. Then after that, they're gonna um subtract the closing stock. So meaning the stock that is left on that day when they actually check how many how much stock they have in the business is literally the closing stock that they're going to subtract. Then that closing stock after they subtracted it, that is when you will get your cost of sales. Yeah, that is when you will get your cost of sales, right? And something I need you to note on this one is that you need to always remember to deduct purchases that are returned. So if they return a purchase, you must make sure that you deduct it, right? Um, so make sure that every time when you see a return, you always deduct it from your purchases, right? So yeah. Sorry guys, I kind of flew, so yeah, I'm sorry if my voice doesn't get projected well, but yeah. Now, let's look at the advantages and disadvantages of these two systems, right? So remember, in accounting, they basically might ask you, because remember, accounting, it has like the statements and it also has theory, right? So when they ask you the theory-based question, you should actually be prepared, right? So let's look at the advantages of actually using the perpetual inventory system. Now, the first advantage is that the business can verify physical stock at any time. So remember, like I said, that since they're recording each and every sale at the point of sale, basically, they get to know what stock is left, what stock was returned and all that. So they can tell you the physical stock at any time, right? They check for stock that is damaged, stock that is stolen and all that. So they actually have it all sorted out, basically, right? Then second one is that the business can prepare interim accounts, right? So in other words, is that um, what happens with that one? So what happens with this one is that a company would basically have interim accounts, so meaning that they would do statements um monthly or in a period of like 2 months or like maybe in a year, they would do even interim accounts or interim statements um during the year. So remember that statements are made after a whole year has passed, right? So what happens is that now with interim accounts, they basically do your income statements, your balance sheets, and all that, but mid-year. So they would do it maybe on a monthly basis if they want. They can do it half yearly, on a quarterly basis, right? So they basically do that to keep up to date, to give up to date financial information to your management, your investors, people that have lended, or like your regulators, right? And it also helps in decision making throughout the year. And to also add on, it's basically maybe if they want to monitor performance and adjust budgets or strategies if needed, right? Because mid-year, since they know how the stock moves, they get to know, okay, now since this is how the stock moves, we need to buy less of stone and more of coke, something like that, right? So that's why they can prepare interim accounts, since they can check each and every sale, basically, right? Right. So now after that, we have what? We have discrepancies, errors, shrinkage in stock are discovered and action can be taken. So the moment they can see that there's a problem in the stock that they have, action can be taken right there and then, right? Rather than in a periodic inventory system whereby they're gonna find out 6 months down the line and they basically don't know when and how it happened, right? Next one is that regular updates in stock help in avoiding deterioration, which means that that is the decline in quality, right? In stock and obsolescence, right? So now what happens with this one basically is that remember that if you don't check your stock most of the time, you won't know if there is stock that is spoiled, right? In the business, you won't know if there is stock that has um expired if you don't check. But since we're using perpetual inventory system here, they basically do check that on a daily basis, or like on a regular basis, so they do know and they actually can tell. So that's why it's an advantage that they will have regular updates in stock when it comes to the decline in the quality, and also to check if there are any expired products, right? And also the last one is that stock can be replenished or replaced timelessly. So meaning that your stock is that they can bring in more stock, and they can replace other products mid-year. Basically, they don't have to wait up until they're done doing the inventory evaluation, right? So yeah, so those are the advantages there, and I hope that they made perfect sense there. Right. Then now we have disadvantages, right? So the disadvantages is that the system is complicated and it requires more accounting entries. So remember that each and every time they make a sale, they would record it. So obviously that's why I would have so many accounting entries, right? Because there's so many sales that they will be doing. So that's the reason why. And also that it is very expensive to run the system. That's why the system, it is done by big companies that are actually able to afford this system, right? So that right there is the advantages and disadvantages of your perpetual inventory system. All right. Now, let's look at the advantages and disadvantages of your periodic inventory system, right? So the advantages is that it is cost effective, as there is expensive equipment like your barcodes and scanning equipment, basically, right? So this one is cost effective. So obviously, since that one, its disadvantage is that it was expensive. This one it's cheap because they don't have to check every time and all that, right? So they basically get to use a cost effective system, basically, that won't need things like um your barcode and your equipment like barcodes and scanning equipment. Because remember, for you to check what's leaving and what's coming in, they literally scan the barcode, same as Pick and Pay. Remember in Pick and Pay, where when you're buying something and they scan it, when they're scanning, it's literally going back in the system telling them that, okay, one of this thing was bought, so they literally subtract it from there, right? But with the periodic inventory system, it never does that, right? Remember when you go to a spaza shop, you never find them scanning barcodes and all that. They just give you, you just take your thing and pay them, then you leave, right? So that's basically the advantage of it, right? It's just that it's cheaper, right? It's an advantage right there. right? Then another one is that it is not necessary to calculate the cost of sale on a continuous basis. So remember, they don't have to calculate cost of sales on a continuous basis. They just sell and sell and sell and sell. Then after maybe sometimes that's when they will start checking the cost of sale on that specific day that they chose to check at, right? Then third one is that this system is suitable for businesses where it is difficult to determine the cost of price of individual items. Remember, sometimes it's not that easy to get the cost price of individual items. So obviously, with this system, it is actually more suitable for businesses that actually can't um, basically get the cost of sale of individual items, because remember that they would need to calculate it on a continuous basis. So if it's very difficult to calculate it, they'll literally have issues every time whereby they have to calculate that cost of sales if they were doing on a continuous basis. So rather do it once after maybe 6 months, right? Then now the disadvantages of this is that um the control over stock is not very effective. So meaning that they do not have any control over the stock. By that we means that um remember, if somebody might come in and tell them how much stock is left, they basically wouldn't tell us. So they basically do not have any control, right? Even if they don't know what is outdated, they don't know what has gotten spoiled in the products, right? Because they never check, so they don't have any control over the stock. Second one is that theft is not quickly detected. A stock take is necessary to determine leakages or theft. Now, remember that obviously, if we're gonna check our stock in each and every 6 months, right? Somebody can steal in February, and when they found out in June, they basically wouldn't know when it happened and how it happened, right? So meaning that theft is basically not detected that quickly, right? They'll basically see 6 months after the stock was taken, or 4 months after it was stolen, basically, right? So that's basically a disadvantage there, right? And then the last one is that the trading stock deficit account is not completed, and the business will forfeit the reduction of taxable income. Let me explain this one very quickly for you. Right, listen very carefully, right? So let's start by talking about what is a trading stock deficit. A trading stock deficit happens when the closing stock or the inventory on hand, physically counted at the year end, is actually less than what is recorded in the accounting records, right? So I think I've also mentioned this in the income statement. I've mentioned this, that sometimes you might find out that the stock that we have recorded in our books is not the same as the stock that that we have on hand, right? So you might find that the stock that we have recorded in our books or our statements or our accounts is actually more than the stock that we basically have on hand, right? And that means that now something is wrong, something is missing. Where is the stock that should be balancing with the stock that's in our accounts, right? So meaning that things were stolen. So that's basically what we mean by a trading stock deficit right there, right? Then that means that now that less stock, right? It's less because now it was due to theft, loss, damage, or maybe if there was an error, right? Now, why is it important for tax? Because here, remember, they're saying the business will forfeit the reduction of taxable income, right? Why is it important for tax? Normally, the cost of trading stock is not deductible, right? Unless that stock is actually sold or no longer available for sale. So, meaning if something was lost or if something is missing in the business, we won't put tax on it because we didn't sell it, right? So, since we didn't sell it, they can't tax us on it because remember, they will text you for things that you have sold, but since you did not sell it, um, the tax is not deductible on it, right? So that's basically what happened. So now, if stock is stolen or lost, a business can claim it as an expense, right? And say, hey, we lost something, so that's an expense since we lost it or it was stolen, right? But only if it properly accounts for the deficit. So remember, in the periodic inventory system, they never know what happened to the stock. So since they don't know, they can account that there was stock that was stolen. So them not knowing that stock was stolen, SARS now is going to tax them on the stock now that was stolen, and that is going to be a huge loss for them, right? I hope that part is very um understandable there, right? So remember, tax sometimes is charged on the products that we sold. And remember, if now the products that we're supposed to sell were stolen, and we can actually show to the to SARS that, hey, this and this was stolen, they will literally charge us for the things that were stolen. And now we didn't even sell them, so we basically are going to make a loss. So that's the reason why it is under the disadvantages. And I hope that was understandable there. Now, let's go into the inventory valuation. Remember that time we were talking just about what? Your inventory. Now we're going to talk about inventory valuation. So now what is your inventory valuation? With inventory valuation is that now the system and methods applied by businesses in order to validate or confirm the value of stock on hand at the end of a particular period. So same as the systems that we're using, right? Businesses obviously need to confirm that the value of the stock um of the stock that they have in the business. That's what we call inventory valuation, is just checking the stock that we basically have, right? And there are three inventory valuation methods. We have first in, first out, which is FIFO, you have weighted average, and you have specific identification. So let's go through each one of those and see how it goes out. Now we have FIFO, first in, first out. Now, this one tells us that the stock that was bought first is sold first, and the stock on hand will be stock that you recently bought. So obviously, if I already had stock with me in the business and I buy new stock, the stock that was already in the business before this one was bought is the one that's gonna first go out. Then the one that just came in now, they basically will be the ones that will be the stock on hand, right? Because those are the ones that are recently bought. So that's what we call first in, first out, meaning that the old stock is the one that we sell first. So basically, this method is preferably used to value goods with short or limited shelf life. So these ones are those ones whereby if you keep on the shelf for the longest of time, they're going to get spoiled. So obviously, the ones that have been there for the longest of time, we need to make sure that they sell first. Now, proper packing and display is essential, right? Because old stock should be in the front and new stock should be at the back. So obviously, for people to see now how it is, right? When they packing and actually displaying it to us, they gonna put the old ones in a place whereby we would easily pick them out before we can pick out the new stock that just came in the business, right? So that's just what it's saying. This one maybe goes out for maybe to Pick and Pay, your Woolworths and all that, whereby they would put things that they want to first sell on the front of the shelf, on the beginning or on the front lines of the shelves. Then at the back they'll literally put the stock that just got in right now, right? So yeah. Now with this one now, the prudence concept is in use. Remember, we have a lot of concepts in accounting. You have your historical concept, we also have prudence concepts, and we have other concepts, right? So here they talk about the prudence concepts, that the value of the stock at the year end is realistic because the stock is valued at the most recent prices, right? So in FIFO, the value of the stock at the year end is actually realistic because the stock is valued at the most recent prices, right? So yeah. Then now we head into weighted average method. Weighted average method. Now, with weighted average method now, it is basically used when lots of stock is brought in small quantities. I made a mistake. It's not brought, it's bought. It's bought, right? So just remove the R from me there. Right? It is used when lots of stock is bought in small quantities, right? Second one is that the average price gives a good composite picture of the cost of the goods. Because remember that since things are but since lots of stock is brought in small quantities, then now we can use the average, or oh, since now for this amount they would buy maybe two, five, six, whatsoever. They don't buy in the same amounts. We can basically just use the average, right? We don't basically need to calculate it individually because we can't tell basically. Since they're buying what? They're buying lots of that stock in small quantities, right? So we basically have to go around it using the average. Then now, at the end of the year, when the closing stock value is determined, the average price will be used to calculate the value of the closing stock. So remember, at the end of the year now, that closing stock is determined to actually um is determined, right? The average price will actually be used to calculate the value of the closing stock. Because remember, with the weighted average, we wait for the year to end, and when the year has ended, we take the aver the amounts that we have sold, the units that we have sold. Then we also check the the cost of it, basically, right? The cost of it, or the sale of it. That if we sold it at this much and we sold this many, this is basically the amount that we get. And that amount that we get is literally going to be the value that we use for the closing stock, right? So we use an average that if we sold things for like 1 million and we literally sold 100,000 units, that becomes the average price of it. And that's how we would calculate our closing stock. I hope that makes sense, right? So now the average cost of a product is calculated by dividing what? The cost of the units by the total number of the units, right? So this one is basically calculated by dividing the cost of the units by the total number of the units, right? So hope that makes sense. So that basically gives us the average of the cost, right? Since now we're just using the stock that we literally sold with the cost of the stock in total, basically, right? For us to get the price of a like of an individual item, of like one item. This is what we use, right? So yeah, not bad. Then now we have specific identification, the last one. This one is the simplest form of stock validation, where every item is assigned a specific cost price, right? So with this one, let's just say a car dealership. In car dealerships, what happens is that each and every car would have its own cost price. Each and every single item, right, in a car dealership will have its own cost price. Then now, each item sold is specifically identified as it appeared on the purchase invoice, right? So if you saw it for 500,000, it will be sold for 500,000. If it was seen for 1 million, it's gonna sell for 1 million, right? So that's what they basically are saying there. Then now, this item is relevant when large commodities are sold and every unit has its own cost price, things like your vehicles and machinery. So this one say it actually explains itself, right? Then this one also it comes back again and says that every item in stock will be recorded at the specific original cost price. This one I think it goes hand in hand with the second point that sorry, that it literally will be sold at the original cost price basically that you would see. So I hope that actually makes sense right there. So yeah, guys, that's basically the lesson there on inventory and stock valuation, right? So what I did in this video is basically just explained the methods that we use, the systems that we have, the advantages and disadvantages of it, right? But obviously we have to do it practically. So in my next video, I will definitely be looking at a past paper whereby we'll be looking at all these systems that we basically have these methods. We're going to look at FIFO, we're going to look at the weighted average. Then we basically are going to look at what? We're also going to look at the specific identification, right? So when we have um uh done that, then I can clearly say that we are good with inventory and stock valuation. I know maybe there are some things that are quite confusing that I might have said, but trust me, everything will be clear once we look at a past paper, and actually the notes that I given you will come in handy when we actually look at the past paper. But for now, thank you for watching, and if you have any question for me, you can drop them down in the comment section below. And thank you for watching once again. Make sure that you like, comment, and subscribe for more accounting tips. And that's it from me. And I'll catch you on the next one.